Good morning, tax pros. Jason Bowman here from TaxMarketingHQ.com, and welcome to today's special radio broadcast of IRS Collections Representation, a sweeping overview. I can never do that consistently for 3 hours a day, so my DJ career is totally off the table. It's a good thing I know how to do tax resolution. And by the end of today, you will know a little bit more about how to do tax resolution as well. So, to delve into what we are going to be talking about today, oh yeah, the administrative stuff. So, certificates of completion, I'll get those out probably at the end of the day. I'll do the IRS CE reporting as well. Do bear in mind that we got to follow those pesky IRS and NASBA regulations regarding issuance of certificates of completion. You got to stay logged in for at least 50 minutes, and you must answer all 3 polling questions. If you dialed in via the telephone to connect to the audio, you also have to be online via your computer or a mobile device on the GoToWebinar app to be able to view and answer those polling questions. If you are looking for the slides, they are available in the GoToWebinar control panel. There's a handouts pane. And also, if you're here, that tells me you got the GoToWebinar link. And in that same email, there is a link to the slides. So check that out. I do welcome and encourage questions. I'm going to try to leave a little bit of time at the end of the session. These sessions always generate a ton of questions. I guarantee you that we will not get to all of them, but I will answer as many as I can in the hour that we have together. However, bear in mind that we cannot address specific client issues or go beyond the scope of this presentation. If you are new to Planet Jason, welcome to my rock in the universe. If you're wondering who the heck I am, who is this loud, obnoxious person screaming at you through a webinar? Well, I'm Jason Bowman. I'm an EA, Certified Taxpayer Representative, NTPI Fellow, blah, 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 blah. And I am a one-trick pony. Very, very, very proud of this. And I don't do tax prep. I don't do examination. I am not an accountant by trade. I come from an engineering background. And I focus my entire career solely on IRS collections representation. I am literally grossly incompetent to do anything else. So I stay in my wheelhouse. I am the author of, 11 books now, including Tax Resolution Secrets, which really it was a marketing piece for consumers to help me get tax resolution clients. And I'm also the author of Tax Resolution Systems, which is a checklist manual for you. My claims to fame, if you want to call them that, are that I grew my own private practice from $0 to $35,000 a month in less than a year. After going into private practice, and that was after I grew an employer's firm from about $750,000 a year to over $3 million a year in just a year and a half. So I'm all about accelerated growth and replication of a business model. Okay, that's a big thing that I'm into. I'm the founder of this company, TaxMarketingHQ.com, and also co-founder of Seattle venture-backed software startup Prolera, which provides HR, compliance, CPE, LMS, fun stuff to larger public accounting firms and law firms. So if you're here from one of those, have your training coordinator call me and we'll talk about Prolera. I also work with hundreds of successful tax resolution practices ranging from solo practitioners, literally kitchen table operations, to firms with dozens of employees. So let's set some expectations about what we're talking about today. This class is titled A Sweeping Overview. Sweeping Overview. And I use that term on purpose. So we're going to cover a broad swath of topics, but not go into detail on any particular area. This class is really intended for those of you that have no prior exposure to what IRS collections representation, aka tax controversy work, aka tax resolution, is really about, like what the type of work is actually involved here. Okay, so really more than anything else, I want you to leave today's class being a bit more familiar with what the IRS collections world looks like, I want to expand your horizons about what a taxpayer's options are. Like, what's the actual thing that we do for them? Hint, it is not the offer in compromise. Okay. And I want you to definitely gain a better understanding of how the IRS looks at a taxpayer's finances, because the financial analysis is fundamentally, critically important to everything we do in tax resolution. Okay. So we will begin with some datums. So this is information from the IRS data book, which is published roughly every March. A little late this year because of some little shutdown thing or something that happened. But the data book publishes all these charts and tables about what the IRS has been doing during the course of the prior fiscal year. And every year I am chomping at the bit to take a look at table 16 of the IRS data book, because that is where the collections activity data sits. Now, what you will see in particular that I want to point out here was that the IRS actually does a pretty good job of closing out cases. There are millions and millions of individuals and small businesses that accumulate a tax debt, and thus a collections case gets opened for every year. But at the same time, the IRS closes out millions of cases. Okay. In particular, you'll notice that the IRS closed out significantly more cases in the last couple of years. And the reason for this is because the IRS increased the individual streamline installment agreement threshold from $50,000 to $100,000 and under a pilot program. And that pilot program worked so well in closing out cases. You can see this huge reduction in open inventory at the end of each fiscal year, that it became a permanent program, and we now have 7 types of installment agreement rather than just 6. The other thing I want to point out here is that this is a significant amount of money every year that flows through collection activities. This is roughly equal to the combined annual budgets, ballparkish, of the Department of Education and the Department of Veterans Affairs. So pick your favorite side of the cabinet, and you're looking at funding both of those agencies with the money collected from collections. So it is a significant ROI. This is about 10x the IRS's annual budget. So collections definitely pulls their weight. Another big thing that I want to point out is that the IRS has a special enforcement program to go after people that have unfiled tax returns. Delinquent tax returns are very, very important to the IRS, and they do a very good job of reducing the number of delinquent returns that are out there. Why do you think this is so important to them? Type it into the chat box. Why do you think the IRS is so focused on reducing the number of people out there that have unfiled returns? Okay, I am going to give you the answer. No, this is not a polling question. This is the attendee interactive part. And I should be yelling loud enough that you're all awake, unless your audio is off. Donna says it's lucrative. Scott says money, 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 money. Deborah says reduces audits. Mark says they want their money. Teresa says it's a way to get more revenue. James, keeping it from getting out of hand. Mary, to close the tax gap. You're all on the right path. Don't forget that the IRS doesn't know how much to bill you for when you enter collections if there's no tax return. Okay? If there's no tax return, they don't know how much money you owe. All right. So Jeff, in order to encourage compliance, our voluntary compliance system, right? In order to encourage that, they have a specific enforcement campaign that they started about 6 years ago to reduce delinquent return inventory. And that department of the IRS does a very, very good job. Just for kind of an aside, for any of you that might not be an EA, CPA, attorney, We usually have a few unenrolled preparers on here. I know tax preparers that stay just as busy the rest of the year as they do during the regular filing season because they're helping people out with these unfiled returns. Or if you're some kind of weirdo that actually likes doing tax return preparation, I have no idea why, but if that's you, then you can build an entire business charging premium fees doing prior year returns. Okay, there's a whole business model involving that, and it's largely driven because of this program. Before I leave this table, one other thing that I want to point out: these 13 million collections cases that we started fiscal year 19 with. Yeah, I know we're 2 days into fiscal year 2020. I realize that, but it'll be 6 months before we get the 19 data. So it is what it is. But out of this, 59% of these 13 million tax debtors are businesses. Okay. The majority of the tax delinquency cases out there are business, not individual. Okay, so there is a tremendous amount of opportunity there on the 941 payroll tax side in particular that should not be ignored. Next up, NFTL activity, notice of federal tax lien. So first of all, you'll notice that the number of tax lien filings has been going down every single year. I will not be surprised if the 2019 data, once we get it, will reflect as being under 400,000. Why has this been going down? Well, in 2011, the IRS increased the filing threshold for tax liens from 5,000 to 10,000, okay, under the IRS Fresh Start program. If you've been hearing a lot of radio commercials from a couple particular companies talking about the new Fresh Start program, those companies are a little bit behind the times. Fresh Start was 8 years ago, okay? There's nothing new about it. The other thing is that the IRS has to pay state and county filing fees when they file a notice of federal tax lien. And the IRS's budget for that has been going down. And so they have to be more judicious about who they file a tax lien against. Now, I want to show you something here. 410,000 federal tax lien notices filed in 2018, but there were 7.8 million collections cases opened. 410,000 divided by 7,800,000. That is 5.2%. Okay, only 5.2% of tax debtors in fiscal year 18 had a federal tax lien filed against them. Okay, I want you to file that away in the back of your brain and save it for about 4 minutes because we're going to talk more about that. Okay, now for companies that have historically relied on tax lien marketing in order to sell their tax resolution services, this drop off has hurt them heavily. Okay, and so you have to expand your marketing beyond just tax liens. This is the only list that you can obtain of people that you know for a fact have a tax debt. This is the only list. It's tax liens. But one, you're missing 95% of the market, and the numbers have been dropping like a rock. Next, real quick, levy and seizure activity. I'm not going to go into great depth on this, but again, notice that in general, there are these massive reductions every year in the number of levies that the IRS is issuing. Okay, in 2014, the IRS issued over 2 million levies. In fiscal year 18, we were only at just over 600,000. Okay, huge reduction. Also, huge drops in seizure activity. There's not a lot of seizure activity. Okay, it's something that you'll very rarely see in practice. Okay, so the IRS is doing, it's their whole try to do less with more, as revenue officers retire, they're not replaced, et cetera, et cetera. And so a lot of this collection activity has been dropping. Now, for the big reveal, a lot of practitioners, if they have no prior exposure to tax resolution, they think that everything we're going to talk about is, it's the pennies on the dollar. It's the reduced settlement program. Okay, nothing could be further from the truth. In fiscal year 2018, the IRS accepted 24,000 offers out of 59,000 applications. Okay, now 24,000 accepted offers out of 8.7 million closed cases. Okay, if you divide that out, it's 0.28%. Okay, not 28%, not 2.8%, less than 1/3 of 1%. And this is consistent across all years. The offer and compromise program is the least important thing for you to even know about. Okay, because the majority of your tax resolution cases will not qualify. They just won't. All right. And so I'm on like this personal mission to fight this misconception about what tax resolution really is, and um, uh, and what practitioners are actually doing in their typical tax resolution work. It's not offers and compromise. Oh, and our first polling question's on your screen.
Hey, Jason.
Oh, hey Dan. Hey, we have a guest. We have a guest poll presenter. Something.
Hey, that last slide you had on there about the offer and compromise. Statistically, both the amount of accepted as well as filed offers and compromises has been decreasing.
Yes.
Why do you think that is the case?
So the offer department, just like any other IRS unit, has been losing staff through attrition, retirement, and they haven't had the budget to replace those people. More than anything, that's what it comes down to. So what he's talking about is 27, 25, 24, 19 will be 23. You know, I think it's budget and staffing. You know, but that's what it comes down to.
Okay. Thank
Do
you.
you have a different take?
No, I just wonder, and they are closing out more cases. The statistics are leading that direction. But they're also staffing up as best they can. But statistically, I heard half of the IRS and a lot of offices are going to be retiring in the next 5 years. So it'll be interesting to see how that looks.
Right, and yeah, even as they replace staff, how long does it? I mean, think about in your own practice, right? How long does it take to train somebody and make them a productive human being within your business? It's
Right.
the same. It's the same for a government job.
Right.
You get somebody fresh out of college or whatever that comes to work in the offer unit or anywhere else, and it takes a while to get them up to speed. Look at the new pool of revenue officers. They just hired about 700 revenue officers over the past like 6 to 9 months, and it takes at least a year before they're bringing in $1, and it typically takes about 2 years before they're like functionally independent out in the field. So there's always a lag time. Anyway, so so where do tax debts come from? Okay. I hope you already know this for the most part. But obviously, if somebody files a tax return, there's going to be an assessment. If the IRS does a substitute for return, aka a 6020B, they'll issue a statutory notice of deficiency. And then if after 90 days, that becomes an assessment. If there's an examination, somebody gets audited, there will be a 90-day letter as well, and that will result in an assessment. Every tax debt starts with an assessment. That's where the whole thing starts. So once we have an assessment, then the IRS will start their IRS Collections Cycle. And this is what that cycle looks like. Normally there's 2 bills. There's a notice of federal tax lien in 5% or less of cases, or at least the letter that says, hey, we can file a notice of federal tax lien. There's a first notice of intent to levy and the intent to the right to take your state tax refund. And then there's the final notice of intent to levy and your right to a hearing. If this comes from ACS, it's called an LT11. It's basically the same letter. This whole cycle, there's time delays, statutory time delays in between each of these. This whole cycle takes about 4.5 months. Okay, so for a 1040 debtor that actually files their tax return on time, they're starting this cycle roughly around June. And June, July, August, September. Oh, hey, what do you know? They're still in that cycle right now. And so all through the summer, there's what I call it second tax season. It's the perfect opportunity for doing tax resolution work. Then there's a second wave that hits with those late filers that are on extension right now, and they're getting their tax returns done between now and October 15th. And then when you get into December, January, February, there's this other wave of 1040 resolution. Okay, and so the beauty of collections work is it's really not seasonal. It's really not. Okay, because when you look at the 941 side of things, there's a quarter ending every 3 months, and this 4.5 month cycle overlaps well into the start of the next quarter. Okay, so this is a never-ending cycle of business opportunity for you. All right, and so if you have a practice where your revenue drops like a rock after April 15th, you're doing it wrong. Okay, and I highly encourage you to look at other revenue opportunities throughout the year. This, in my opinion, should be one of them. And there are also plenty of practitioners, myself included, that we just didn't do tax prep. I just didn't do it at all. I just did tax resolution. Okay, so and there are plenty of businesses that's all they do is tax resolution. And I'm not just talking the big fly-by-night companies. I'm talking kitchen table practitioners. This is a great gig to do in like a semi-retirement situation. Um, uh, you know, if your 401k isn't exactly stock full of shares right now, this is something that you can do kind of part-time, and it's really good money. Okay, so point here is that it never ends. So after we have an assessment, there is something else that we need to talk about that arises when the assessment is made. And this is in Internal Revenue Code section 6321. It states that if any person liable to pay any tax neglects or refuses to pay the same after demand, the amount shall be a lien in favor of the United States upon all property and rights to property, whether real or personal, belonging to such person. This is the statutory tax lien. There is a huge difference between the statutory tax lien and the notice of federal tax lien. Again, less than 5% of tax debtors normally have a notice of federal tax lien filed against them. This is something different. This is the statutory tax lien. The reason that this is important to discuss is that the IRS's collection enforcement ability legally extends from the statutory tax lien. This is where their authority to be aggressive and levy and all that stuff, this is where it starts. Okay, and here's the other thing that you have to be aware of. Under IRC 6322, the lien imposed by section 6321 shall arise at the time the assessment is made and shall continue until the liability is either satisfied or becomes unenforceable by reason of lapse of time. Okay, so the IRS, 95% of the time, they never file a 668Y, the notice of federal tax lien, with your county clerk and recorder or your secretary of state. However, they still have a lien against everything that your client owns because of the federal statutory lien that arises the moment the assessment is made. Okay, not 10 days later, not 30 days later, not 90 days later. At the time the assessment is made, there is a federal statutory lien. Some practitioners call it the secret lien or the silent lien, but trust me, it's neither secret nor silent. It still has teeth. So why should you care about the liens? Well, I already said that you should effectively ignore offers in compromise because they're very rare. Okay, lien work, lien withdrawals, lien subordinations, discharging an asset from under the lien, this is far more common than doing an offer in compromise. Lien work, collectively as I call it, will be central to approximately 5 to 10%-ish of your case resolutions. The IRS is willing to play ball a little bit in order to free up access to capital, credit, things like that, in order to quote unquote facilitate collection. It is important to remember that all taxpayer assets are subject to the statutory lien, and you need to get the IRS's permission to finance or sell those assets. that's an opportunity for you. Okay, those people need your help to do that lien stuff. Now, real quick here, we are not going to delve deep into this just in the interest of time. I'm like 4 minutes behind. But understand that the government has 10 years to collect the debt. Remember here, this lien continues until it is satisfied or becomes unenforceable by reason of lapse of time. Well, how long are we talking about? Well, it's generally 10 years from the date of assessment, and the final date that the IRS has to collect on the debt, the end of the 10-year statute of limitations, is called the CSED, Collection Statute Expiration Date. Now, there are things that extend that 10-year period. For example, in rare cases, the government will file a lawsuit in federal district court against the taxpayer and seek to reduce that debt to judgment. And then the federal judgment statute comes into play, which is 20 years. Okay, the IRS literally only does this like a couple hundred times a year. It's incredibly rare. Okay, there are also administrative actions that extend the 10-year statute of limitations. For example, if a taxpayer files bankruptcy, the IRS is subject to the same stay of collection enforcement as every other creditor in a bankruptcy situation. And so because of the fact that they cannot take collection action, they can administratively extend the CSED. If you file a collection due process appeal, if you file an offer in compromise, if a taxpayer moves overseas for greater than 6 months, those are all actions that stop the clock from ticking, okay? There are, Dan, how many are there total? Like 40, something like that?
I think it counted 38 or 39.
38.
I forget exactly, but at least that many.
Okay. Dan teaches a statute of limitations class. Actually, that was what, Monday that you did that. So Dan teaches a great class on that is literally just an hour talking about nothing but this concept. Okay. So if you want to see the list, go to Internal Revenue Manual section 5.1.19 for the exhaustive list. But really what I want you to take away today is that the CSED is 10 years and there are things that can extend it that are things that you'll do in the course of representing a client. And understand that if you stop the clock and the clock only has 2 months left on it, you may be doing a disservice to your client. You need to know what the CSED dates are for every case you work, all right? Which means you need to pull transcripts and do a bunch of research, all right? Resolution pathways. So we have an assessment, we have a statutory tax lien, and we know that we have issues with the tax lien, and we're going to do some research, pull transcripts, use software if you want to, but also trust but verify the software. And you're going to know your CSED dates. Then what you need to do, every case you work, by the way, goes the exact same process. You do research, which is usually pulling transcripts, and then you do a financial analysis. No matter what your client's situation, no matter what their sob story, no matter what type of tax it is, no matter what, every case progresses the exact same step-by-step sequence, okay? Research, so you pull transcripts, then you do a financial analysis. Pull transcripts, do a 433, okay? Pull transcripts, do a 433. Pull transcripts, do a 433. Every case, without fail, same process. And the reason I'm hammering that home is because practitioners always say, I have this case, I don't know where to start. Pull transcripts, do a 433. That every case starts the exact same without conversation, okay? Because the transcripts will tell you certain information, and the financial analysis will tell you this. The financial analysis tells you what your resolution options are, okay? So what the IRS is typically going to look at, especially on the liabilities over $100,000, they're going to look first at assets. Does the taxpayer have any assets with equity in them? If they do, the IRS is going to expect you to either borrow against those assets, do some sort of cash out financing, or to sell the asset. So you have to make appearances. That's not the right cliche. I don't know what it is, but what they want to see is at least 2 or 3 loan applications and loan denial letters from financial institutions. So you can go back and say, oh, I tried to borrow, but I owe the world $1 bazillion and my credit's in the toilet, and so nobody will give me a loan. Too bad, so sad. Okay, but here's the loan application and the denial letter. I at least tried. If they are able miraculously to get a loan, and sometimes they can, then you're going to be doing a lien subordination to subordinate the federal tax lien to a junior position to the incoming financing. If they're going to sell an asset, then you're going to have to do what's called a certificate of discharge. Okay, so lien work. After looking at the assets, then we enter the disposable income section. The technical term is actually remaining income. If a taxpayer has, under the IRS formula, and we'll get to the form here in the next slide, but if they have more income than their allowable expenses under the IRS formula, then the IRS is going to go, ooh, we get a monthly payment, and we expect that amount of money to show up on our doorstep every single month. All right? A lot of practitioners come back and say, well, if all I'm doing is setting up a payment plan, why is the client paying me? Okay. And, I throw that back around and say, well, why would they pay you for a tax return? Why would they pay you $500 for a tax return? They can go to Walmart and buy TurboTax for $50. All right. Okay. It's the exact same argument. It's because people are either scared to death of screwing it up, or they don't have the what's the polite way of putting this? They don't have the mental fortitude to figure out how to do it all. Quite honestly, it's mostly just scared to death of screwing it up. All right. So 90% of what you do, especially on the individual side, will be setting up installment agreements, but you still get paid for those. Okay. Because what you really bring to the table is this. Your job becomes to maximize allowable expenses, okay? Maximize allowable expenses and minimize reported income, okay? So do everything that you legally and ethically can, and there are things that you can do, believe it or not, to maximize those allowable expenses and reduce income, all right? And we spend like 2 hours talking about how to finagle those numbers in our IRS Collections Fast Start Bootcamp. And I'll talk about that schedule here in a little bit. So that's what you get paid for, okay, is making the delta between expenses and income as small as possible, because most people want to pay as little money to the IRS as they can. If the taxpayer has no assets and no disposable income, then they're probably looking at being eligible for not collectible status, CNC. Okay. And then, of course, what about the offer in compromise? Well, it's very formulaic, very, 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 very formulaic. Except in rare situations, which only a couple, probably 200 or 300 of them happen every single year, called effective tax administration cases. It's all down to the formula. Okay, it's a math problem. And right now, the eligibility criteria for the offer in compromise have never been better. Congress created the OIC program in 1965. Okay, it's not like it's a new program or anything. But the IRS has been gradually reducing the eligibility criteria. And even with the disposable income multiplier at only 12 or 24, I mean, when I started in this business, it was 48 and 60. Okay, so it's easier now than any time in history for anybody to qualify. And you saw the numbers earlier, hardly anybody actually does qualify. But when you do the financial analysis and you do the full 433A or 433B, guess what? You're simultaneously looking at their eligibility for IA, CNC, and OIC. Okay, you're looking at eligibility for all three of them when you're doing a proper financial analysis. So, because financial condition is so important, okay, especially on the individual side, okay, on the Form 433A, which is the IRS Collection Information Statement for individuals, Section 5 of the form is probably the most important. This is where you apply the allowable standards, the collection financial standards. And this is how you determine what the IA payment or offer and compromise remaining income amount is. So over on the left-hand side, this is the income and expense table, the IET, and you'll see all these income sources. It's important for you to understand this is not a tax return. You must take your tax preparer hat off in order to prepare this particular form, because you'll go, oh, this is not taxable income, so it doesn't need to go on an IRS form. Nay, nay. Any cash coming into the household that is available to pay living expenses needs to be listed here, regardless of its taxable nature or not. Okay, so things like child support, alimony, VA disability benefits, SSI, anything of that nature has to go on the income side. Then on the expense side, we have all these expense categories. And again, in our Fast Start Bootcamp, we go into extreme detail about breaking down each of these categories, what's included in them, what the limits are, how to massage the numbers, and how to take advantage of some perks inside the financial analysis handbook of the IRM that a lot of people don't really delve into. And the bottom line is this line 50, okay, the net difference between income and expenses. So this grid is very, very, very important. So again, we use remaining income to calculate IA payments. Remaining income gets multiplied by 12 or 24 to determine a minimum offer amount. This grid gets applied to determine CNC eligibility. If this is a negative number right here, then we're looking at a CNC situation. So in other words, literally like 95% of our resolution options for 1040 cases in particular depend upon line 50 of Form 433A, okay? So the financial analysis becomes super duper, super duper, duper, duper important. Polling question numero dos is on your screen. Did I say that?
We have a few good questions of some people. I don't know how much you want to get into it.
Yeah, I said at the beginning I'm going to do questions at the end just because of time.
Okay.
But if there was something specific you were going to say that I just cut you off from, go for it.
Well, no, it's just, talking, some people are asking some detailed things both about fees, about liens, although
remember, this is an introductory class, a sweeping overview. That's why I said that at the beginning. We could spend hours and hours and hours here going down little rabbit trails.
Yeah, I mean, our as Jason mentioned, the Fast Start Bootcamp is 16 hours of CPE. I just taught that in Dallas last week. And there's a lot of detailed stuff. Everybody, ranted and raved about how good the material was and, how we present it. I think it was beneficial. Most practitioners know at least some of the basics. They just, don't know the details. The more you feel comfortable with it, the better. And so this is where, we're just teaching you the basics here to get this started. And James and Paulo, we'll give you some things at the end of some webinars and other things that we do that can give you some details on some of the more intricate deep dives in some of the material.
Yeah, I mean, if you add up all the CPE classes I've created, I probably got, I don't know, 80 to 100 hours worth of material to cover to go down all the rabbit holes.
Unique hours. They're not.
Yeah.
There's some overlap, but it's not the same repetitive material.
Yeah. All right. So installment agreements. Installment agreements are your bread and butter. If you're doing a lot of tax resolution work, which I encourage you to do because the money's so good in it, that you're going to do a lot of installment agreements. Okay. And so again, just to look at some of the numbers, less than 1/3 of 1% of IRS collections cases last year were resolved via the offer program. That rate's been going down. So tax resolution does not equate to OICs. Roughly 15% of individual tax debtors will wind up in CNC, okay? At any given time, according to TIGTA, there's about 2.5 million Americans that are in non-collectible status. There are literally thousands and thousands of people every single week being put in CNC and taken out of CNC. It's a fairly static-ish number. Okay, I don't have a data point for the business side, unfortunately. Roughly 5 to 10% of your cases will be resolved through either full payment, something involving the sale of an asset, the refinancing of an asset, and unlocking cash in an asset. So that's the lien work. Everybody else, roughly 75, 80% of cases, will be on a payment plan. Okay, payment plans are where you make your living in tax resolution. There are now 7 different types of installment agreements. There's the guaranteed installment agreement for income tax liabilities under $10,000 that can be paid within 36 months. There are streamlined installment agreements for income tax liabilities under $50,000. There's the streamlined test criteria that a year ago became permanently part of the IRM is the expanded IA for income tax liabilities up to $100,000. There are 2 types of installment agreement specific to payroll taxes. There's the in-business trust fund express installment agreement for liabilities, trust fund liabilities less than $25,000. And then there's the in-business trust fund regular installment agreement for trust fund liabilities greater than that. And then you'll notice that the IRS has all these special names for these special installment agreements. So they needed to give a name to a not special installment agreement. So literally regular IA is the technical term, okay? And sometimes people will be able to make a payment every month, but remember that 10-year CSED clock that I mentioned earlier? Well, when that 10 years expires, the IRS can't collect any more money on that liability. And so there is something called a partial pay installment agreement, PPIA, where a taxpayer will make payments for in whatever amount that they can every month until the CSED expires, and then that liability, the rest of the liability goes away. Okay, if you squint real hard and turn your head sideways, that might start to sound like an offer in compromise. Okay, so just because your financial analysis indicates, oh, offer, you always need to look and see whether a PPIA might be a better deal. And we go into this extensively in other classes. Hint, it has to do with the length remaining on the CSED. A real big point that I want to make about installment agreements. So my checklist for, which is available in that tax resolution systems manual, you can hop on over to Amazon and grab after we're done here if you'd like. On my client intake checklist, one of the things that I have on there for myself is that I want to propose my installment agreement within 14 calendar days, 2 weeks of the client hiring me. The reason that I have that standard is because when you request your installment agreement, the IRS has to process it. And when they process it, they enter a code into the computers that prevents the automatic issuance of levies. So wage garnishments, bank account levies, things like that will stop if you have a pending installment agreement request. Okay, you can request an installment agreement through any communications method that allows you to convey to the IRS the identifying information of the taxpayer, the specific tax liabilities to be covered, and your proposed payment terms. So you can request an installment agreement by leaving a voicemail. You can send a fax to ACS or an RO, certified mail, return receipt. If you can figure out a way to get it there by carrier pigeon or by Morse code, okay, it's a valid installment agreement request. So I usually do everything in triplicate because I want to make sure that they can never say that they didn't get it. So voicemail, certified mail, return receipt, and fax are the way to go in my opinion. And by the way, Don't forget that if you're dealing with ACS, the automated collection system, the folks in Ogden and the other service centers that are working collections, you can leave them voicemails after hours, okay? And somebody does listen to those voicemails, and you can leave installment agreement requests on those voicemails, okay? You can also fax to ACS. Don't forget that. So a big thing here, however, that we need to talk about for a minute is being current and compliant. The IRS cannot grant you an alternative resolution to the non-payment of taxes if you're not current and compliant. And what we mean by that is that you have to be current with the current period federal tax obligations, meaning that you cannot be accumulating additional tax debt. So think about a business. If they owe for several quarters of past 941 liabilities, and you want to put them onto an installment agreement, they need to be making their federal tax deposits on time and in full for the current quarter. Otherwise, the IRS will not grant them a payment plan. They can't. They're not allowed to. Okay. The other thing is that they need to be compliant with filing requirements. So any unfiled returns, and there are many, many caveats to this, all right, that we don't have time to get into. But in general, the IRS has to label them as compliant. Now, under federal law, there is a 6-year statute of limitations for failure to file a tax return. So most of the time, you're going to hear that the taxpayer needs to file the most recent 6 years worth of income tax returns if they have an income tax liability. In an offer and compromise situation, they always have to file those any unfiled returns. In an IA or CNC situation, it's a totally different conversation. The IRS lost a Supreme Court case a few years ago in which it was declared that the failure to file returns does not eliminate eligibility for non-collectible status. And then on the installment agreement side, it's negotiable, okay? The IRS wants to get people back into the system, wants them to be productive taxpayers, and so they're willing to work with you, okay? And so typically 3 or 4 years is typically what I've seen is what the IRS will require to be filed. But I've had situations where it's only 1 year, okay? Just because the records didn't exist, everything was such a mess. You got somebody that's running a cash-based business, and the IRS just wants them in compliance, okay, and wants them to pay taxes going forward. They want them to be an income source to the government going forward. And so, yeah, sometimes they'll accept only a 1-year return, will enter into an installment agreement on that 1 year of assessment. And then the taxpayer has to pay their normal taxes and file everything going forward. Okay, those situations do happen, even if they haven't filed a tax return in 30 years. Okay, those situations are not uncommon. But in order to get a payment plan, they have to be current and compliant. Okay, they have to be labeled as such, even if certain unfiled years are, it's probably a bad term to use, but they're like quote unquote kind of written off. All right, that happens all the time. So that's where you have to be in order to get an IA. So just out of curiosity, how many resolution cases have you worked so far this year? Next polling question is up on your screen. Ten more seconds on the polling question. And we're going to talk about CNC real quick. So don't go anywhere yet. I have you for 11 more minutes, and I'm going to use them. All right. So what if somebody's broke? What if they are flat out broke? Well, back in 1980, the IRS issued a policy statement in response to some criticism that they had too many open cases in inventory. So I actually like to say that the CNC program was created as a PR move to make the IRS look better. But here's what it says. If after taking all steps in the collection process, it is determined that an account receivable is currently not collectible, it should be so reported in order to remove it from active inventory. The policy statement says that as a general rule, accounts will be reported as CNC when the taxpayer has no assets or income which are by law subject to levy. And that subject to levy phrase is important because this is where I have to remind you that accounts that your taxpayer thinks are protected from levy action are not. So cash value of life insurance, Coverdell savings account, 529 plans, traditional and Roth IRAs, 401ks, 403bs, those accounts can all legally be levied by the IRS. Now, there's certain things like an ERISA governed defined benefit plan, a pension, those cannot be levied because of ERISA, but most retirement accounts and other tax advantaged accounts can be levied. Okay. However, the IRS is not heartless. They say that if there are limited assets or income, but it is determined that levy action would create a hardship, the liability may be reported as CNC. A hardship exists if levy action would prevent the taxpayer from meeting necessary living expenses. What are necessary living expenses? Goes back to those collection financial standards that are applied on Section 5 of the 433A. So back in 1980, this is where the collection financial standards came from. This is where they started, was in order to give the IRS a tool for determining what was necessary living expenses or not. In CNC cases, each case, a determination has to be made as to whether the levy would result in actual hardship as distinguished from mere inconvenience to the taxpayer. So the same applies to levies on assets. Let's say you have a 78-year-old client who owes the IRS $2 million. Their only income is Social Security, and they have, let's say, $40,000 in an IRA that they're taking RMDs from. You have a very, very, very strong argument to make that it would create a hardship for the IRS to levy that IRA because of the age of the taxpayer and the low amount of Social Security that they're getting, and that they need that money in order to simply not die. Okay, they got to have a roof over their head so they don't freeze to death. They need to be able to buy food so they don't starve to death. You're literally making an argument of my taxpayer might die if you levy this account. All right. And so that is a very common argument that you will make in a levy appeal. And we don't have time to get into appeals, but that is a common situation. Is you have somebody with a little bit of money in a 401k or an IRA, but they're retired or close to retirement, and it would literally create a lifelong hardship if that money disappeared, because it'll help supplement Social Security income, okay, or a pension. So very, very common argument. So in other words, if a taxpayer owns nearly nothing and has no remaining income, they may be eligible for CNC. The number one benefit of CNC, number one, is that when you put a taxpayer into non-collectible status, that 10-year statute of limitations clock keeps ticking. It doesn't stop, okay? So the statute of limitations can expire while somebody is in CNC. They may never have to pay a single penny towards what they owe. Now, if you squint real hard and turn your head sideways, doesn't that sound like a better deal? A better deal than an offer and compromise? This is why you should never just straight jump to the offer and compromise, even for a broke client, because a PPIA or long-term CNC actually kind of compete with the offer and compromise program for what might be a better deal for the client. Okay, it's also part of why the offer rate is so low, is because people that are genuinely destitute, you put them in CNC instead, and they write out the statute. Okay. The nice thing here is that it's simpler in the long term than an IA or an offer. The clock doesn't stop, and for legitimate hardship cases, case closure is fairly simple and quick by IRS standards. Okay, if you have a client that owes less than $25,000 and you're going to put them in CNC, it's literally a 20-minute phone call with ACS. I mean, after you wait on hold for 3 hours. But it's a one-page letter, and you attach a 433F and you mail it to ACS. Case closed. Okay, as CNC. Now, obviously, we've barely scratched the surface. Again, the whole purpose of this class was to hopefully expose you to some options in tax resolution that you may not have known about, or that you weren't clear about in terms of what the industry looks like, what casework actually looks like, what processes actually look like, and what kind of a day actually kind of looks like in doing tax resolution. And so I hope that you got that out of this. But obviously, there's all types of rabbit holes that we can go down, especially as we can see from all the questions that Dan and I are seeing coming in. Details of the 7 types of IA. Like somebody asked, is a direct debit installment agreement required? When is it? When is it not? Okay, we cover that in our Fast Start Bootcamp. How do we calculate the minimum offer amount? Called reasonable collection potential. How do we calculate that? And it's something you should know how to calculate, even if you're using software. Just like you should know how to prepare a tax return, even if you're using software. You should be able to do it by hand if you had to. What are the details and application, and what are those legal and ethical kind of tricks that we can use in application of the collection financial standards to benefit our client? It's important to know how the IRS conducts financial investigations, what they look at, what they closely scrutinize, and what we can do to grease the wheels on that process. And then a big one to me is how to work with appeals. Over 50% of my case resolutions occurred in appeals. So you have to have a working understanding of especially how to do cap appeals and collection due process appeals. Okay? And there's a lot more, such as how do I actually get clients? What kind of fees should I charge? How do I actually get somebody to sign an engagement letter and a power of attorney and close the sale? Because a lot of times we're accounting people. We're not used to really having to sell, but tax resolution is a service that's not a commodity. You have to have a little tiny bit of sales training and mentality and skill in order to get those clients. So I'd like to invite you to join Dan, mostly Dan, for an upcoming IRS Collections Representation Fast Start Bootcamp. At these boot camps, we do them around the country, usually about one a month, and you can earn up to 16 CPE hours. So it's a 2-day class where we delve, neck deep into a lot of the details of what we just covered in a sweeping overview. So you'll get the skills that you need to resolve roughly 90% of all 1040 tax debt cases that you will ever see. Okay. Plus, you'll walk away with a systematic process for doing the marketing, okay, attracting clients, quoting the fees, closing the sales, and then working the cases. I'm all about being efficient and methodical and doing things the same way over and over and over, systems, because that's what creates efficiency, and efficiency equals profitability. So here's what the class looks like. This is the agenda. And Dan, feel free to pipe up if you got anything that I'm kind of missing here that you want to add. But the morning of the first day is we start with marketing fundamentals. Okay, how do we get clients? Because you're going to have to do different types of marketing for tax resolution than you're probably used to for doing tax preparation marketing. Then there's an hour on fee structures. There's different fee structures, and then we share some average fees that your colleagues charge. and then a step-by-step process for walking somebody through the consultation process. Okay, the consultation process that ends with a check in your hand and a 2848 signed. Okay, then there's a break for lunch, and then Dan will take you through a structured approach to the client intake, doing the financial analysis, determining your resolution options for your client. Then we end with a super deep dive into those collection financial standards. Okay, and then we pick that back up again on the next day with a client financial analysis case study and discussion that goes back to, again, what I said earlier with an IA, where your job is to maximize allowable expenses and the things that we can legally and ethically do in order to do that. So the financial side is so important. We spend 4 hours on it, 4 hours. Then we'll delve into the 7 types of installment agreements and the intricate details of each of those, the eligibility criteria, and how to get those set up, as well as greater detail on CNC. And then after lunch, the way Dan does the offer and compromise class is that it's heavily focused, again, on the financial analysis side. So all told, out of these 16 hours, there's probably closer to probably 5 hours of the financial analysis once you include the RCP calculations with it, and then ending the day 2 with appeals, again focused on the collection due process appeals, which you primarily do when the normal IRS channels aren't getting you your installment agreement or CNC that you're trying to get, and so CDPs are a great way to get those. And then also CAP appeals, collection appeal program, the Form 9423 program. That's what you're going to use to get levies released. So roughly an hour on each of those classes. So this is what the schedule looks like. The 2 in green there at the top, November 11th and 12th in Richmond, Virginia. Those are already on the schedule. These are available for registration, December 5, 6 in Atlanta. The other dates that you see here, these are tentative. Dan and I had a lengthy conversation over the weekend to do the schedule for next year. And I am normally not that great at planning ahead. And so this will be the first time, I think this is the first time ever where we've actually planned the year ahead, isn't it? Yeah,
well, these individual boot camps like this, yes.
Yeah, normally I'm like 3 months ahead at best. So as you can see, we'll be all over the country. Again, most of these are Dan, and so I hope that you can attend some future webinars and get to know Dan a little bit better. I will be in, let's see, I'll be at that one, I'll be at that one, and I'll be at these. So basically the summer ones. And if you're interested in this, when you register, use promo code 100, so 100, and then off, all one word, so 100 off. That'll take $100 off the normal registration price. And that promo code will still work for these 2020 events, even though the registration pages don't exist yet for these. That promo code will still work, okay? So those will be available to you. Hop on over to taxresolutionseminars.com. If you're interested, what you will see there is that actually forwards to my Eventbrite page, and you will see this. And you can see the Richmond and Atlanta events here. Again, those are open for registration. And then Dan should have the Key West info to me probably within a few weeks. So if you're in South Florida,
you want to come to South Florida in early January.
Well, yeah, I guess some people are into that.
Well, you're the cold weather guy, I'm the warm weather guy. So
yeah, exactly. So yeah, go to taxresolutionseminars.com. You'll earn CPE, and We talk about marketing and the sales process, which a lot of people don't talk about. I mean, there are other, like there are other classes. I'm an NTPI fellow. They don't delve into the fees and the marketing and stuff like that um, uh, in those NTPI classes. I don't think the STPS does in their boot camps either. Plus, also, I think a lot of those other classes are straight up overpriced for what you get. And so, we're about was it 40% less. And so with the coupon code also about half off from what you'll pay for some of those other boot camps. And obviously I'm biased, but I think that we provide more practical information. So I'm all about giving you tools that you can actually apply in a pragmatic manner. So everything that I teach, the curriculum I've developed, and fortunately Dan is on board with this, is making it practical so that you can actually go back to your office and use the stuff. It's not just theoretical or internal revenue code discussions. It's here's what you actually do with it. And I hope that that's come across in today's webinar.
Yeah, let me add, Jason, just being that I was literally in Dallas last Thursday, Friday, in front of a room of about 34 people, and everybody there were at differing levels, but most of them had not really, other than if we had three of our members in the room that have been with us. Most everybody found it very helpful to the approach that we did, helping to understand the marketing, understand the fees and the sales approach. We've got a lot of good questions on that. Even one of our members came up to me and said, thank you for helping him to recoup thousands of dollars that he would have otherwise, lost in his practice. And we teach you a lot of that. And the one thing I always tell people is this boot camp, it's CPE, it's continuing education, but there's not many, if any, continuing education seminars that you can go back to that we leave you with some ideas and suggestions that you can literally recoup your money for attending within a week. So that's it's been very helpful. We got a lot of good comments. In fact, got a lot of people to join as members that wanted to be with us and spend more time learning the details and some of the tools, additional tools that we offer from that side. But this boot camp is a I tell a lot of stories, examples, case study approach that is hopefully very easy for people to understand.
Yeah, and personally, I think when I compare the current curriculum to what we were teaching like 4 years ago, it was very painful, like personally, because the curriculum was kind of my baby, right? Because it took years to develop, but taking some of the stuff out of the curriculum in order to spend more time on the case study examples, the exercises, and the financial analysis, because it is so freaking important. I think it's turned into a more practical class for people to leave with skills to help their clients. So even though it pained me a little bit to cut out certain aspects last year, it worked out well, I think. And I'm very proud of the curriculum that we've put together now.
Yeah. No, I mean, we've gone through this and we've had to axe things that we used to have in there, like talking more about the liens. But, I mean, this is designed to be sort of a beginner's approach, if you will, to help people to understand, and obviously a lot of these things, for those of you that do tax prep work, they translate over into that side of the house, and we give you some practical knowledge and experience, because I run a tax practice myself that I have bolted tax resolution representation, expanding more into exam representation as well. So hopefully that will help. Now, did you want to mention about that there's actually a gap in our calendar there?
Yeah, so March, we kind of figured nobody will probably come to a remote city for boot camp in March. And by the way, the April one is after April 15th. It's at the end of April. And so in March, we do an online presentation. We've done that. I think this will be the third year. And what we do with that is we do our best to make it convenient during an inconvenient time. And we spread the 16 hours out in 4-hour blocks across 4 weeks of the entire month. That's how we've kind of been doing it, so that you're not completely taken away from your tax prep side of things if you do tax prep. And so that will be available. I'll probably have that set up. It probably will be till January before I have registration set up. But the online version does exist. I'll be honest, I think you get more out of coming to a live class. I know I do. It's really difficult to replicate it's pretty much impossible to replicate the interactive case study discussions in the online version. But for those of you that we absolutely cannot get to you geographically, or you cannot travel for any reason, then the online version, we do offer that once a year.
Right. Yeah. I mean, it's just hard to, because you do learn some things. Like this last class, I had a retired revenue officer and a retired or a former revenue agent in my class, and they were actually very insightful in adding some behind the scenes, what do you call it, behind the curtain, or as Jason, you like to say, even though you're not a sports guy, inside baseball type of information. And so, you don't get that kind of stuff through the webinars, and it's just not as interactive. I mean, it's educational. You're going to learn some stuff, but the problem is with webinars, if you're like most people, when you go to a webinar, you're distracted by things. If you don't turn off your phone, if you don't, you're sitting there looking at your computer, people come in and interrupt you. There's a number of things that can happen that the live sessions just make it better. Not only that, but if we're in an area near you, you can bring your staff and do certain things like that as well. And Karen, no, there are no more polling questions. We are done with polling questions.
Oh yeah. If you were only here for this continuing education, you can go about your day. We're just shooting the breeze now, pretty much. Colleen asked, she was in the Dallas class there with Dan last week. Is there more to this class I can go to? So, Colleen, what you might be interested in is the roughly every 6 months I do an advanced workshop. So back in May, we did a 3-day workshop entirely focused on kind of advanced 941 representation. So totally on the business side. Here in 3 weeks, I'm doing a 2-day workshop here in Colorado, entirely focused on lien work. So every 6 months, I do an advanced, highly topical, deep focus class on that. And there's several of you asking about New York. Jason doesn't do New York City. I don't like big cities at all. I don't even like going to Denver. And
Jason
so,
doesn't like the East Coast, let alone New York City.
Yeah, I don't like going to the East Coast.
No, and what you're looking at right now is the, again, tentative schedule. That's where we're going. Not to say that we can't go to New York City or somewhere near there in future years, but this is where we're going. Hopefully we're coming someplace close to you, but I would say the closest to New York is going to be the Boston, or where else are we going to be?
Actually,
Richmond.
Richmond's not, I mean, there's a train.
Yeah, Richmond, possibly Charlotte, or we're going to be the closest ones to New York as of right now.
Wallace says Albany. If we're going to go to Albany, we might as well go to Buffalo. That's a joke for some of you that know me.
Right.
There was somebody else had a question here. Vonda asked, do you provide back office tax resolution support for sole practitioners or referral program. So we do, I'm not talking about it here, but Dan and I do run something called the Tax Resolution Academy. It is a digital membership community, as well as, you know, unlimited CPE. You get 50% discounts on the boot camps and the workshops. You get access to tons of marketing materials, and within that program, we do a biweekly office hours calls where we can delve into your client specific cases. So we do provide things of that nature. If you absolutely don't want to do the work, but you have a client that needs help, we have hundreds of members across the country within the Academy program that we would be happy to refer, put you in touch with them for referral basis. And all of our members are, it's not like a requirement or anything, but we highly encourage the payment of referral fees. So if you're, unless you're an attorney where there's limitations on that, if you're a CPA or EA or an unenrolled preparer, the payment of referral fees is acceptable, and we encourage our members to do that. So Vonda, yes, we can definitely help you out with that. Drop an email to, I'll throw Dan under the bus here. Drop an email to Dan, dan@danhenCPA.com, and he can help you out with finding somebody to refer a client to if you need that.
Right. That's Dan with one N, Hen with two N's, just so that you guys know. But that's perfectly acceptable.
Richard had a question here. Do I have to have a 2848 on file with the IRS before I can set up an installment agreement online? Yes, if you are setting up an IA for your client using the OPA tool, online payment agreement tool, then yes, you do need to have a 2848 on file. The handout needs to be updated. Yeah, I need to. I probably only update the handout once a year. And when the year gets long in the tooth like it is now in October, then yeah, I need to update that. We had several questions related to houses and liens. If you're interested in the lien workshop, you can also see that at taxresolutionseminars.com. And bear in mind that is an advanced class. And we will spend a significant amount of time talking about liens in relation to real estate transactions. But Gina had a question here. Will IRS work with you for subordination on a lien on a house a client wants to refi to pay off the IRS debt? And the answer is yes. That's the entire purpose of the subordination process, is to move the IRS lien to a junior position, to another creditor, because that creditor obviously will demand to be in first position and lien priority. And so that's the whole purpose of a subordination. And there's an application, there's a process, there's a waiting period, and we'll talk about that in the Loveland workshop. We'll do a hands-on case study example, and but yeah, the lien subordination is the answer to that process. That is the entire answer to your question. And there were several very similar questions I saw scrolling through here too.
Yeah, we had a few lien questions.
Paula, really good question. So ask for a retainer up front and only continue work on a prepayment basis. Basically, yeah. Collect as much of your fee up front as you can from these folks. You don't want to become just another creditor. And have a predefined payment schedule if it's necessary. And if they miss a payment on that payment schedule, then you stop work, revoke power of attorney, and spend your time helping people that are actually paying you.
Hey, and let me add on that, Jason, that a lot of practitioners always seem to be concerned with going into tax resolution because of that type of a situation, because they're concerned that people aren't going to have the ability to pay.
Right.
just pay anything, let alone pay a down payment or make monthly payments or whatever. But, I just tell people, don't be concerned with that. If they want to hire you and deal with their IRS debt, they will find the money to pay for it, whether it's a credit card, they have it in savings. I mean, keep in mind, they've been living on 100% of their income, to this point. That's why their tax liability has been increasing. And so, whether they have to borrow from family or friends or get gifts or, sell something, they will find the money. I mean, I'm dealing with a state sales tax case right now that I told the guy, he's got to find some way, because he's dealing with criminal problems right now. But he's got to come up with close to $80,000. And, he's going to come up with some way of finding that money to come up with some big lump sum. So just don't fret over that. People will find a way to pay. And if they don't, then, it wasn't meant for them to be your client anyway. But as opposed to a tax return where sometimes people hem and haw and they complain about a, $200, $500, $1,000 fee. Because when you're dealing with tax resolution, there are more cases you're going to get that are well above those ranges, and they find the way to pay.
Yeah, and the other side of that coin is the people that owe $8,000 and they don't want to deal with the IRS. They're scared to death of the IRS coming after them, garnishing their paycheck, etc. Those cases exist as well, and it's somewhere on my top 10 list of biggest pet peeves. It is practitioners that they file a tax return for somebody. There's a small balance due, less than $10,000, so it's a guaranteed installment agreement, and they set up the payment plan using the Form 9465 without charging the client any extra money. I think that you're doing a huge disservice to yourself, but I think also to your client, because you're setting expectations that your services are not worth any money. If you're setting up an installment agreement for a small dollar amount, honestly, regardless of the amount of the liability, the value billing, the value pricing argument for that service is a higher fee than the value of the tax return. Okay, that's just the reality in our capitalist market, right? And so don't set up an installment agreement for like a $50 form fee, because that's what Drake or whatever has pre-built in for the Form 9465. No, it's a separate engagement. It's a separate fee. It should be at least $500, and it needs to be treated as a separate professional service. That's one of my biggest pet peeves. If you don't think that you can charge that, then we're entering a whole other conversation about your personal relationship with money and your valuing your own time and your professional expertise and all that, right?
Yeah. And I have that discussion with the people who come to the boot camps, and I say,
Sure.
you need to start having a mindset shift. You need to know that you're worth more. And it's like, I almost say basically this is like, if you need somebody's permission to know that you're worth more and bill more, then you have my permission. It's like, we sell ourselves short. We're all,
Right.
kind-hearted, helpful, want to, do people. And a lot of people will let themselves get kind of walked on. And, they look at the commodity of a tax return and charge what they think they should charge, or charge what H&R Block is charging. And you guys are worth more. I mean, you're providing a lot of experience and value. I mean, somebody like Christine here, she's a former revenue agent working for the IRS, and she has some experience and she's bringing it to the table. I mean, a woman who was 40 years at the IRS as a revenue officer, she was like, should I charge $50 an hour is what she was telling me. It's like, no, you should be charging like $300 to $500 an hour. Her experience has a value, whether it's to a client, taxpayer, or us as practitioners.
Yeah, just see Christine's comment here. It says that if you think your prospects do not have the funds to hire you, that is incorrect. People purchase what is important to them, and what you do is just about the most important thing someone can invest in. Your intellectual capital is worth every penny.
I'm going to steal
Spot
that. I like that,
on.
Christine.
Spot
That's the
on.
most succinct, best way I've ever heard that put.
Yes.
So yeah, so that's, that's the best way to put it.
Well,
Um,
and if you don't believe this, by the way, so um, I can say this. I grew up in trailer parks. Um, if you don't believe that people don't have the money for what's important to them, I kid you not, go drive through a trailer park sometime, okay? And you will see brand new Corvettes and Mustang GTs sitting in the driveway. At night, you'll see blaring through the window these giant 65-inch OLED TVs that are I literally just bought I'm 41 years old. I just bought my first TV 2 weeks ago, first TV of my life. Okay, and I was blown away at how much TVs cost. There were like $5,000 TVs on display, and that's what people are spending their money on. Okay, and so people will find the money, like Christine said, for what's important to them. And if resolving the tax liability is truly important to them, then they will find the money. I've had clients that have had their mothers pay my fee. I have had clients that had to put my fee on a credit card. Practice tip: do not accept a debit card for payment of your fee that is attached to a bank account that was levied. Ask me how I know. Um, uh, Christine says, yeah, people buy stupid, expensive wheels and rims for their car and are in debt up to their eyeballs. Exactly. So if it's truly important for them to get their life back on track financially, then they'll come up with the money. I also like to say we are the wealthiest country on the face of the earth in human history. Okay, we live in it. Okay, yay us. So there is so much money floating around this country that it's insane. Okay, and we have such easy access to credit and capital that you can find money for pretty much any project. I mean, look at WeWork, right? They raised billions of dollars from people to go rent office space and then release it out at triple the price of what you pay for the same thing at Regis. Okay, so like there's money floating around. You just got to go get it. So bottom line, people will find the money to pay your fee if it's truly important to them. And if it's not important to them, nothing you say, you could be the greatest salesperson on the planet, and you will never convince anybody to deal with their IRS problem if they don't want to. So, end of rant. Oh, Christine's
so
she's got some good ones. You cannot want it more than them. Yeah, Christine, you're quotable today.
yes,
That's a good one.
yes.
All right, we're at the bottom of the hour. Again, we're just shooting the breeze now. But yeah, hopefully, I hope that all of you got something good out of the webinar that ended half an hour ago. And so, if you're still here waiting for the last polling question, we're long done. And Dan, you did a good job. Thank you on answering people's technical questions as we went along. I just saw that. Thank you. I
Great.
appreciate that. So yeah, I hope that you have a better understanding now of the collections landscape, better idea of kind of what's involved in actually doing this kind of work, if you haven't been previously exposed to it. And I also hope that you found this a bit more engaging and entertaining a little bit compared to most CPE webinars that you attend. I try to liven things up a little bit. And if you want to delve deeper into this, go to taxresolutionseminars.com. We've got Richmond, Virginia coming up November 11th and 12th, Atlanta, Georgia at the Cobb Galleria, December 5th and 6th. Mr. Hen will be teaching those himself. Use promo code 100OFF to save $100 off the regular registration fee. And if you are a Tax Resolution Academy member, use the links inside the Academy portal under the Events tab, because members save 50%, actually. Get a pretty significant discount for being an Academy member. So with that said, Dan, want to carry us out with a tune?
Yes, no, thank you very much for, putting this on, for everybody being here, and for those of you that have stuck around. When we tend to do these together, we will stick around and answer questions, provide insight every once in a while, get on a rant or something of that nature. And, obviously with the people who are here, it makes it more helpful. So thanks for putting it on today, Jason, and for allowing me to be here.
Thank you, Dan. Everybody have a great rest of your week and enjoy the rush to October 15th.
Later.
We're ending the webinar.